Welcome back, everyone. This is a brief update on news from the gold market. My name is Angelo Zittis, and we start with the title for this week. Correction does much, but encouragement does more. Gold came tumbling down since our last report, forming another unexpected movement, but this time in the opposite direction. The strong downward movement could be an indication that economic risk and uncertainty may be diminishing due to some changing circumstances, or simply a strong selling momentum followed by many traders that led to the precious metal to where it is at the moment. In any case, this report aims to discuss the main drivers of gold's price at the moment and at the same time give our own opinion on the matters. Yesterday, even though gold's price attempted to correct the steep downward movement formed on Friday, traders seemed unable to display that sort of confidence and finished the session with a break-even activity. However, we place more emphasis on the momentum formed on Friday, as some important headlines may have caused the sell-off in the first place. On Friday, the 28th of February, reports from various sources like Bloomberg stated that the US Fed Chairman Jerome Powell acknowledged the coronavirus as an evolving risk to the US economy and may have implied that they were ready to cut interest rates if it's absolutely needed to maintain the current healthy state of the economy. It seems that even though the US economy is displaying confidence with the inflation, GDP, and employment rates being at satisfactory levels, the risks could be mounting due to external matters. Countries like China, Japan, and Australia are said to have already been affected by economic uncertainty due to the virus outbreak. These countries trade between them, but also trade with the US, which directly links their economic weakness to the largest economy of the world. Currently, according to Fed funds futures, the current probability for a rate cut is at 55.4% for 75 basis points and 44.6% for a 50 basis point cut. In previous weeks, one could be considered naive, stating that the Fed is heading to a cut, and most importantly, over 25 basis points. However, as economic risks have spread so fast, we consider this a very possible scenario due to the fact that other central banks like the ECB and the BOJ are also considering taking action. The financial markets at the moment price in a 10 basis point rate cut by 62% at ECB's March 12th meeting. The main question is, however, what is driving gold's prices and traders for the time being? With lower rates and even negative rates, in the case of the ECB, the central banks will be aiming at discouraging investors of banking their money and trying to uplift money flow into investing and spending. Generally, they are trying to create economic activity in their economies, which is a measure usually taken to counter risk and to stimulate growth. On a short note, we would also stress the fact that until the present moment, the relationship of other instruments with gold's price is also of great interest for traders and could be used to their advantage if used wisely. As a first choice, we pick the US dollar, which in the past weeks has kept a parallel movement with the precious metal. In this case, when gold's price is down, the dollar follows, and when dollar is up, the yellow metal responds similarly. On a separate front, in previous reports, we have noted the importance of financial releases, especially from the US, that have driven gold's price accordingly upon release, with the effect sometimes continuing in the next sessions. However, we must note that lately the effect on gold's price from financial releases has become milder. In our opinion, this effect has derived from increased and serious pressures that were noted above, which have an international effect and could affect continents, governments, economies, and even investors, companies, and small to medium businesses as a result. Nonetheless, we would like to note the most important financial data from the US and let our viewers decide whether gold will react or not. So, on the 4th of March, we get the ISM non-manufacturing PMI along with the Market Composite and Services readings. On the 5th of March, we get the initial jobless claims and the factory orders, while on the 6th, we get the US employment report for February, which in the past has created strong market reactions, and caution is advised should you trade gold prior or upon the release. Moving to our technical analysis, this is gold's 4-hour chart. Our noted possible levels in an ascending scenario for the precious metal is initially the R1 1610.15 line that was tested twice on the 2nd of March and on both the 19th and 20th of February. Then higher could be the R2 1633.70 level that was tested constantly from the 25th to the 28th of February, and the R3 1660 line, which with our R2 level already mentioned, were the boundaries of a sideways motion for the pre-mentioned period. This is the sideways motion we're talking about. So this is the R2 level, and this was between the 25th and 28th. Thus, we used the R2 and the R3 as possible stops higher. On the downside, the first level is the S1 1585 level that was tested in the past 2 days, and even lower is the S2 1564.50 level that was tested 2 times on the 28th of February but was not breached, while it was also intensely tested on the 6th to the 13th of February, but again was not breached. We're referring to these two stops on our S2 level. This was on Friday the 28th, and this is the period in February, that's the 6th until the 13th, that the S2 level was tested. Even lower, we could see the S3 1550.30 level that was last seen on the 4th and the 6th of February and in late January. Thus, we believe it's a tight level which must be mentioned before moving further south. Now, the other RSI indicator is just rebounding from the 30 level and potentially could move higher. If you've heard something in this report that you found useful, make sure you apply it to your trading. That's the whole point. Thank you very much for your time. We will see you soon.